15,000 to close the week. But better than that, over $1,000 was produced during the overnight trade. So for those that want to trade a small account, they don't like to actively trade, and all they want to do is open a trade, you could have easily returned $1,000 while having your trade close overnight. One of the things that we've discovered recently, which has been a massive assistance to those who are under the PDT rules, therefore you have under 25K inside your margin trading account or margin options account, is that Hood is allowing you to open trades and allowing you to have a much longer post-market and pre-market trading session hours. And so one of the trades that we set up, which we call one of our overnight trades, is a trade we take every single day. And we usually end up having a profit target that closes us out within the first 2 hours of the day. But for those who, for whatever reason, aren't available because maybe they're trading from Asia or they're trading from the Middle East or Africa, and just that morning hour isn't suitable for them, this trade is actually a trade where you can take your profits overnight. The other beauty of all of our systematic trades is that day to day, you know exactly how much risk you are holding. One of the big problems that people face when they're trading discretionary trades is that every single trade has a completely different risk reward. So every time they have to analyze against their portfolio how much risk this is causing them to incur, and at the same time analyze how that is impacting against all the other trades that they're taking. Because one of the things that I've noticed from a lot of day traders or shorter term swing traders is that their entire account is just long. And when you are only long, you are seriously exposed to how the market is playing out. If the market is bullish and all of your trades are long, then of course you're going to feel great. And over time, the markets are bullish. But as we have seen, there are entire seasons where the market can just be moving sideways, and those consolidations can kill somebody's stock portfolio, especially if they're holding a lot of shorter duration options, because theta decay can kill you very, very quickly. So one of the things that we've just been really excited about is that, with our systematic trades, we are able to scale the amount of risk that somebody has to hold overnight and allow those that are more conservative in their trading to be able to focus on some of the lower risk trades that also have daily consistent returns, whether that be an iron butterfly or a double diagonal or something like a simple calendar. So, we have people in the group that are trading in a $2,000 account all the way up to people who are trading with hundreds of thousands of dollars. And we want to make sure that there are trades available for everybody's risk appetite, because it's very easy for somebody to come on YouTube and say, and don't risk 1% of more than 1% of your account on any one trade. But if your account is currently only at that $5 mark, taking a bunch of $50 trades is going to be very time consuming. You are going to just take so many paper cuts that you're going to feel like you're not really able to get over that hurdle. And you're going to end up putting yourself in a situation where your trades are a little bit too far out the money. They're structured with a bit more risk because they're just not really perfectly structured for what is happening in the wider market to really be able to catch longer duration trades or to be able to catch those shorter duration trades. Because a $50 position really isn't significant enough to give you both time in the market and positional advantaging. Now, of course, with using things like calendars or long butterflies, you can get those positions down in value to make them not as expensive. But if that's the only thing that you are allowed to trade day in and day out, it means you're going to be working probably about 3-4 times harder than everyone else. And you may begin to feel frustrated because in the beginning, to build up your account to get those 100, 200% returns over time, you are going to have to work a lot harder than someone that can have one position on that returns them a very significant amount of money, because a $2,000-$3,000 position can be held at like the perfect advantageous point. The point, in fact, is that last year we had one SPX trade which cost about $2,000 to enter. And then we did scale in because that was you know, quite shortly after that was the whole tariff tantrum situation. So the trade did actually drop down a bit. And I told people this position is still a very good position. If you would like to add another contract to be able to scale in, feel free to do that. Now, some people said, no, the position is great. And even though I paid, maybe it's not as valuable right now, we have enough duration on the contracts that I'm not really concerned about it. So that trade actually went to over $60,000. And that's one trade that was $2,000. But if somebody only has a $2,000 account, that's 100% of their account. And then seeing a 30-40% drawdown during that very short term April dip after the tariff tantrum might have caused them to get nervous and close out. Where somebody else that has a 15, 20, $100,000 account, that $2,000 position, they will be able to sit in because they have conviction of what the purpose of the trade is overall. But that one position by itself got them well over $60,000, which for an account that was only $20,000, that literally doubled their account size or tripled their account size just in the 6-7 months that we held the position. So having this positional awareness and looking at your account size and looking at how much time you want to spend in the market day in and day out is a really crucial aspect of options trading, because yes, options gives you leverage. Yes, it reduces the cost of entry. Yes, it allows you to manage things like volatility and time decay and ABCD. But the thing is that you really want to also make sure that your positions are positions of strength, that you are positioned at prices that make sense, that you're not too far out the money, that price never really gets to you, that you have such short duration that if you are not constantly right, back to back to back to back, that you just aren't making money on your trades, that you need a perfect directionality. Also, because options work with options flow, what people call charm and bana, that you really need the price to be moving towards you with a consistency, especially if you have shorter duration trades. Those things start to matter a lot more, because when you're in a small account and you're trading consistently with really tiny contracts, getting that flip on your return is very difficult. You also don't ever want to be 100% executed with your account. But when your account is only $2,000, you constantly feel this pressure to kind of throw everything into the market at one time. And so you put yourself at a lot of risk for needing to be overextended all the time and to potentially over leverage yourself in each of your positions. And really what it is that you're hoping to get that kind of home run from one of those smaller positions that kind of helps you push your account to that next level. But that's not really how we like to trade. We like to trade very, very systematically. It's not that we don't take discretionary trades. Last year, our discretionary trades, if you only traded each of them with one contract, returned well over $120,000. If you paid attention to our charts and how we were kind of talking about how we were trading the positions. But our systematic trades, each of them also returned a very significant amount of money. One of our systematic trades never requires more than $500 of loss, where another one of our trades kind of bounces in a range of somewhere between $1,500 and $2,500 of risk. And you take that risk every single day, but you're flipping the account with this kind of scalp trade. And you're always looking for about a 20% return on risk. So if your risk is $1,500, then that day you will be looking for about a $300 return. And we like to keep our win rate as close to or above that 90% win rate, so that we know that when we have to manage losses, it's not as big of a deal, because we know that our wins are going to more than compensate for the losses. And then we have other trades where your max risk is about maybe $1,500 and you're in that for about a week or 2 weeks. And then those trades are looking to get a 100% return on risk. But oftentimes they do produce more than that. So just depending on the type of trade, our systematic trades give you diversity in the amount of time you hold, diversity in the amount of risk that you're holding, and diversity on how much exposure you have to volatility and how much reliance you have on the move of the market. And then we have all of our discretionary trades, and our discretionary trades are really focused on either share accumulation or they are focused on catching really nice directional moves, breakouts, breakdowns in that price action. So one of the things I was really excited about this week is that a number of our trades have just done really, really well. Not just our systematic trades, but let's just get to it and I will show you what that is looking like. So this week, as I said, we had that really nice return, and you can see that there are a couple of losses. Now, one of the things I always try to explain to you guys, just to make sure that it's really clear, is that we hold in this part of the account, when we're showing people trades, we act as though we are holding this trade to the point of expiration. And as I always say, the reason that we do that with you guys is because we really want you to learn how the Greeks move with these trades. And so if you don't see how the trade acts all the way into the point of expiration, you don't really see why we talk about things like gamma risk or the theta decay at the very end of the day, or how delta changes at the point of expiration, where you get that kind of binary effect where all the positions that are in the money go to 1 delta and all the positions that are out the money go to a 0 delta. And so, those kinds of things, sometimes people have to see over and over again, like, what does that look like? But if you are managing the trades, which you should be, because we do call out the management, you see this trade went all the way up to 33%. So you should not have taken a $1,200 loss. The net credit we received was $4,200. So at 4:30 p.m. my time, which is about an hour and a half after market opens, this trade had already decayed by 33%. That was well over $1,000. So you are nearing a $2,000 return. If you leave that kind of trade to go to a negative $1,200 return, that means you're just not paying attention at all. And we are shouting to you guys, hey guys, we are decayed 10%. We're decayed 20%. Put in those stop losses. Put in a stop profit if you can't watch. Set up an alert. We're giving you those signals. But overall, you can see that the trade did really, really well. So if you are managing the position, then you would have, on this trade alone, you would have returned easily $1,000-$2,000 because it opened well above $1,000 in return at market open. And market open, my time is 3:30 p.m. So 1 hour after market open, this trade had already decayed by 33%. And it is the same thing here, that this trade opened at a 16% return, and that would have been nearing your 20% target on risk. So, these are the kind of ways that we keep compounding and scaling. But you can see that, all of our other trades did exceedingly well throughout the week. You had trades that, even if you didn't manage them at all, could have easily returned you $3,500, $1,200. But again, all of the trades here, as we post them out in option strat, we do like to keep them open until end of day so that people can really figure out, like, when we talk about gamma risk, when we talk about theta risk, when we talk about volatility risk, those things aren't just like ethereal concepts or whatever, like philosophical ideas happening in the middle of nowhere. They are real ideas that can significantly impact the return on your trade. But this is what the education is for. That's what the Discord and the community is for, because you're constantly getting our feedback about, what the return looks like and how you might want to manage the trade. One of the other things is that sometimes people, when, we do these kind of weekly roundups, we are talking about the trades that we have closed in that particular week. But it doesn't mean those are the only types of trades that we take. So something I did want to kind of throw out there is all of our open trades. So you can see that here in the Discord. We try to post very consistently kind of all the returns of all the different types of trades because we do know there are people with different size accounts and they need different types of trade with different types of risk. And we want people to get exposure because, for example, if you're sitting in a trade like, if we're looking at something like Amazon, we want you to be in Amazon, but maybe you can't afford a leap, or maybe you can't, or maybe your account needs more risk. So if you're in a bigger account, you might want to trade that costs, a couple hundred or $1,000, opposed to another person who doesn't want to put more than 3 or 4% of risk in their account. But all the trade options are there. As you can see, you have diagonals, you have calendars, and you also have leap diagonals. So there's a serious diversity of trades. But one of the things that's unique to Trade Speakeasy, and I keep saying this, is you will very, very rarely see positions where we are just long, where we're just in long calls, we're just in leaps, because that's not how we trade. We don't want exposure to volatility, and we don't want exposure to time decay. So our positions, in a lot of ways, function a lot more like shares. So the thing you really just have to be asking yourself is the trade moving in the direction that I want? Or is it, am I getting some kind of benefit from the time decay on my positions? Because one of the biggest things that people miscalculate with just long calls and long puts is the amount of time they need, and they just overexpose themselves to potentially theta decay and volatility decay. But we're not really so concerned about either of those things because we are always positioned long and short every single trade we're in. And you can see that even if you don't know what these types of trades are, you can always go and, watch, if you watch any of our videos or come in and do education with us. But here you'll see, we have calendars. We have short straddles. These are all positions where you are both long and short the underlying so that you aren't exposed so much to that theta decay. But I do want to show you that we are in a diversity of types of trades. It's not just that we only trade SPX. It's just that you often see SPX in the list of our weekly roundup, because those are the trades that we are in and out of 0 DTE, 2 DTE weekly. So you see a lot of the SPX trades kind of flipping through our account faster than some of the other positions that we are in. And so you can see that, we have a significant number of diversity of trades, and not all of them are green all the time, but most of them are green. And something like this, like a meta, which is currently, underwater, we have quite a bit of time on the trade. And the expectation is that earnings should be able to reposition our profit loss and be able to move us towards better profitability, which is why we haven't yet closed the trade. The other thing, because we are both long and short the market, we are able to adjust our position. So maybe as we get past earnings, if we don't get the move that we are expecting, then we can always reposition that to pull that diagonal in closer without having to put in more positions, more funds to be able to reposition that. Because one of the biggest failures that people have with longer duration trades like leaps is that as their trade is kind of decaying in value, the only thing that they feel positioned to do is to add another leap, and then to dollar cost average into their options. But the problem is that then you end up in a situation where every single one of your options have a different kind of volatility exposure, a different time decay, a different positionality. And so then when you even get the move that you were expecting, you might not necessarily make the money that you thought, because every single one of your contracts actually has a completely different contract base when it comes to volatility, time, the options flow, ABCD, the price action, the delta. All of those things are so unique that by the time the underlying has moved, you actually don't know what your exposure is to any of those individual Greeks. And that can cause you to end up bleeding money even when the price does what you're expecting. But for us, we're not going to be that concerned about it. So here you see, I mean, I'm pointing out the loss to you in your face. We are down per contract $580. That is 71%. However, we have two positions. We have a short position at the 1030 and a long position at the 1060. And if you look at the trade on Meta, you will notice that we have two different expiration dates. So I have between June 18th and September. June is the expiration of my short call, and September is the expiration of my long call. I have like almost 3 months of time. So what that means is I might say, you know what? I don't like the 1030 target for Meta anymore for September, but I think maybe like something closer to the current price would be really perfect. So all I have to do is roll out my short call 1 or 2 months, take in a credit, and move down that long call with the credit that I received. So I'm not putting out any more money into that position. I am literally manipulating the short position to bring in additional credit and then using that credit, flipping it into my long, and then bringing it closer to the current price. And no, this isn't alchemy. This is just really doing very, very simple math. And oftentimes people are like, no, 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 it's too confusing for me. And honestly, like I talk my kids through this. I have a 6-year-old and a 9-year-old, and I'm always making them do this math with me because I want to see like how does a child who only, my son can do basic, addition and subtraction, and he's starting to do multiplication and division in school. And my daughter is obviously much more advanced because they're already starting to learn like simple equations and solving for variables. But so there, they'll sit down and I'll give them the concept. I'll talk it out to them and they'll be able to figure it out because they just reduce it to kind of simple math. They're not trying to overcomplicate it. Because one of the things I've noticed with options traders is you already have a bias of what you desire the underlying to do. And your desire doesn't do anything to the simple math. The math is the math. So once you learn how to do the math of options, it gets less complex over time, especially when you have an entire community that's like working it out with you. But I do think that that's a really important concept that does allow us to make more money than most other traders because we are never in a position where we're driving without a seatbelt or driving without gas. Like our car is always on full and we're always with the seatbelt. We have all the pieces in place that we know we can get from point A to point B very efficiently every single time, right? So, that's what we try to communicate to people. So let's and then we have another page of contracts. And so you can see that obviously like these are the SPX trades that we're in currently. And those are all kind of baking in the background and doing really well. And so, you're kind of making your money while you rest. But those are trades that kind of roll over quite quickly, where the other positions are much longer in their duration. So let's just move on because I do want to talk about a type of trade that has done really well for us. And I just want to show you that here. It's not going to really show me anything, but we have this AMD short straddle that we were in that returned us $3,500. And this is a really important type position. So I'm just going to flick over quickly to the chart. And so right now, AMD is at $350, and our return on the trade was $3,500. But when we entered this back in January, let's see, where are you, January? We were around here. So we were somewhere between $225 and $250. So for those who wanted to enter this trade would, if you didn't already have any shares of AMD, you would have had to buy 100 shares of AMD, which would have cost you about $20,000. But the credit that we received on this position, if you notice, $3,500 is 50% of what we received. So we received actually $7,000. So that kind of reduced the cost of the 100 shares by about 35%. So from the 100 shares, if you had to go out and buy 100 shares because you didn't own any shares of AMD, instead of paying, you know, $20,800, you would have actually only had to put up about about $1,300. So it would have saved you about $7,000 on the cost. And so, but then the benefit is that as the price of AMD is going up, your shares are making money. So you're making money on the return on all of those shares while your short straddle is decaying in value. Now, whoops, what you have to also notice, let me move this over so you can see the entire position, is that our strikes were at the 250. So it means that we were expecting a move from around the 210, 215 mark up to the 250. And as long as the price was within our profit range, and short straddles create this kind of tent looking profitability. And I'll show you, what that looks like in a second. But just, let's talk it through now for a moment. So on our shares, the average price, let's say that you didn't own any shares before and you kind of were stacking in at this 200 to 220 kind of range when we did this call out, you would have put out about $2,100 on the trade if you had only bought shares. So the person who only bought shares put out $2,100. And then, of course, they're making over $100 on each of those shares. So you would have then turned around and made easily another $10,000 on the shares, right? But for the person who sold this short straddle, on first instance, they didn't pay $2,100. They actually only paid about $1,300. So their return on their shares is almost 100% because they then ended up getting the return on 100 shares, even though they didn't pay for them, and they returned this $3,500. So now they are able to buy to close this position, and they actually took a realized gain of $3,500 on top of the realized gain of the $10,000 on their shares. Now, the good thing is that when you own 100 shares of the underlying, you are able then to do short straddles as a consistent income producing trade. And so our goal on any shares that we own is that within 12 months of the initial purchase of the shares, we should be able to get a 100% return from the options, regardless of what the shares do. So even if the shares literally made $0, I don't care because I didn't pay for them. 100% of the return on the value of those shares from the initial cost of entry, I should be able to produce approximately from utilizing short straddles if they are done correctly. But again, this also requires you to understand a bit of the Greeks and to be able to follow some instructions and be able to watch the educational content in order to learn how to do it. But people who pay for shares, that's not actually how it has to be done. I'm not saying that you shouldn't do that or you can't do that. Obviously, there are billionaires out there that have paid lots of money for all of their shares, and they're happy to do that because they have the cash to. But as a principle or as a thesis for how you utilize options, if you are holding those shares longer term, so more than 12 months, you should be reducing your cost basis substantially, if not by 100%, by utilizing concepts like short straddles. And no, if you are doing things like covered calls and short puts, you will never produce more than about 20% of the return on the value of those shares. So if that's what you're utilizing as a strategy, you are probably looking at making between 10, 15, and 20% return on the value of those shares. You are not looking at returning a 100% return per annum on the value of those shares. So it is a strategy you might want to learn. And it's a strategy that we utilize all the time inside the Discord because that is a significant way in which I constantly make sure that I'm beating the market because I don't ever need my shares to do anything. So if my entire share portfolio just sat and did fuck all for the next 20 years, I genuinely couldn't give a shit because my short straddles are giving me nearing a 100% return and sometimes a lot more per annum. So, that's just to kind of give you a perspective of like, how does a mom with two small kids like figure this out? Like, I don't have to trade anything else if I was just trading short straddles. That's like how high my conviction is on this type of trade. Now, I'll show you what that looks like in option strat so that you can see through like how the theta decay works, right? So let's just build out, or actually, if I go to my active trades, I have a bunch of short straddles. So let's see, where is one? Of course, because I'm talking about it, we're not going to see it, right? So here, APLD short straddle. So this is showing the long shares. And so this was a call out inside the Discord. So for people who didn't already own shares of APLD, let's just look at that chart really quickly so that you can see what that looks like. So I've been telling you guys since time immemorial that this is something we've been scaling into literally since $5. So people inside my Discord, if they have been consistently scaling in as we have been doing these trades, as we talked about, they could have easily had by now hundreds of shares. But let's say you just joined the Discord, you never heard of APLD, it didn't exist to you, which is totally fine because that's part of like our work with you is to like help you get into these trades. But the shares, so you would have spent on the shares, here you can see we were long 100 shares at $32. So this would have cost you $3,200 to get in. And the credit that we received was almost $1,300. So again, we reduced the cost of entry by 33%. So you would have spent $3,200 to buy 100 shares, but you would have taken in $1,200 worth of credit simultaneously. Now, let's just act like we don't own the shares so that we can see what what the straddle looks like. So you see how the straddle forms this kind of peak. So when you first enter the trade, obviously it's like, let's say for instance, you open and close the trade on the same exact day. You're not going to sell the straddle for $1,300 and then buy it to close on the same day for $1,300. Obviously, you will have time in the trade, right? We entered this trade on April 20th, which is just like a week ago. And, the trade is already up just on the short straddle, $50. Besides the fact that you are up on the shares by, so you have $3 per share. So you're up $300 on your 100 shares. So your return now is $350. But as you see, like as the time goes on, this peak area starts to move up. So the profitability just starts to kind of move up with you. And then you are able to make money as really just as time decays. Like I don't need, like right now, the shares are at $35. Let's say between now and June 18th, APLD stays at around $35. I'm going to make $800 on this trade by itself. $800 easily gets me nearing 30 shares of AP, or I should say 23 shares of APLD. So like 23 of those shares has just, they were free to me And now I can like rinse and repeat and do this strategy again. Um, Even if APLD goes back to the $32 mark, so my shares literally made no money, I'm still going to make $500. So, that's as if I made um, almost what, like, on the 100 shares, like 50 cents a share. So, again, it's not a tragic amount of money to make in literally 2 months, right? Like, nobody's getting those kinds of returns at a bank or whatever. And even if APLD were to drop, even back down to the $28, I am still making money. So while prices are volatile and you see like your shares are kind of, hopping around, maybe you're in that pullback season, you are still making money on your short straddle. So this also gives you a buffer zone so that you don't have this like hockey stick of unrealized and realized losses where like if the price goes up, I'm going to make money. And if the price goes down, I'm just going to start losing all of my money because options can give you this really nice buffer. Now, one of the things you can, if you want to like dig deeper in, is that the reality is our expectation is that APLD was going to squeeze to the upside. So we positioned our short straddle out the money. However, like during seasons where we are not expecting the price to go up and we are expecting more consolidation, what we could have done, and let me just build this out for you, is like, let's say, for instance, I go into the group and I tell everybody, listen, APLD hit 35. I don't think we're going anywhere else. I don't see us going up to the $40 mark in the next 2 months. So instead, I'm going to sell my straddle right here at the 35. So I'm going to sell it at the money. So I close my previous one and I open a new one. Or maybe I didn't get the first call out, so I want to do a new idea. And so I just set up this $35 strike short straddle. Here you can see that I would still take in $2,300 and or sorry, $1,300 of credit. And all price would have to do is just kind of chop around in this range and have a really wide range, right? Like price can come all the way down to 22 and I would still be making some money, or it can even run all the way up to the 48 and I'm still making some money. Obviously, the more it does what my thesis expected, that it kind of stays chopping in this $35 range, then I am just decaying. And at the point of expiration, I can get near to this max profit. And because of the way we use gamma and charting together, we do very often hit these pins. So more often than not, we are able to get not the entire max loss, max profit, because we're not sitting in these trades until their expiration point. We are, trying to rinse and repeat these because, again, as I said, our main idea is that we really want to hit 100% return on the initial, at least the initial value of the shares that we got into. Now, of course, if somebody bought APLD at $5 and you're returning $1,300 per, or let's say even just $1,000 per short straddle, you are producing well over 1,000% return on your short straddle against the value of those shares. So this is another reason why it is really good when you get those market pullbacks to try and accumulate those shares at that lower kind of price point, because as the price of the underlying grows, you are able to set up these short straddles, which then have a lot higher delta, a lot higher price value, a lot higher positional value, and you are able to see something like a $1,300 return. Now, if you look at something like, let's say, let's look at something like Joby, which I think is quite inexpensive right now. Oops, that didn't want to change for me. So that's an $8 stock, right? Or $8.50. So let's say that I'm expecting it to move to the $12. And so I sell to open this straddle. It's giving me almost, it's giving me $420. But like relatively speaking, $420 is a lot when the underlying is only worth $850. But now imagine if Joby does what analysts expect and it moves to the $25 mark by into 2027, then imagine how much that like these straddles would be worth. They would be worth very similar to what we are seeing on APLD. So then the next time we go in to sell a straddle after such a move, we could be seeing easily 800, 900, $1,300 per short straddle. And then you would have the decision, do I want to keep scaling in to this underlying, or do I want to just now generate extra income and then maybe position myself into other up and coming companies? But this is a great way also for those who really like those growth companies that are higher risk, things like, the Navitas or the different drone stocks or the different space stocks. This is a great way to minimize that kind of volatility exposure you have as those cheaper stocks are kind of finding their base and then establishing their kind of corporate presence and their PE ratios and establishing some of those longer duration financial data that some of the larger institutions require for them to be able to get in. This is a great way to say, you know what, I really like a Lunar, or I really like a Redwing, or Redwire, or I really like a whatever, an ASTS or something like that. I really like that, but I don't really want to dedicate, $10,000 of my share portfolio to that. But this is a great way then where you can say, you know what, if I'm getting a 33% kind of safety guard, then yeah, then I'm a little bit less hesitant to kind of giving myself that expression of being in the shares. And that has served us really, really well, because some of the other companies that it has, these short straddles have allowed us to get into are things like Umbrella, the battery company. And, we've already made quite a significant amount of money over the last year on the short straddles that even though it went, from $52 up to this $95 and then came back down to the $50 mark, we were never in the red because overall the income we had generated with those short straddles had always kept us in the positive month over month. But it did allow people who maybe didn't get their shares at the very bottom when we were calling it out down here on this kind of rounding bottom. This allowed them another opportunity to be able to scale into shares at a cheaper price. Another company that we've been doing this on consistently is Rocket Labs. Another one is HUT, also 𝐬𝐿. And you do get to a point where you've generated so much income on these short straddles that you genuinely don't really, I don't want to say you don't care anymore about the share value, but you're not making your biggest return on the shares. You're actually making your biggest return on the options. And so just by having 100 shares or owning in 100 share increments of the underlying, you are then able to consistently sell these short straddles. If these are at all strategies you want to learn how to utilize, whether it's the calendars and diagonals I talked about later, or the short straddles or whatever, then you do want to get inside the Discord because we provide all the educational material. We're an educational community. Like everybody that has gone through their journey, they're so excited about what they've learned and how they've learned about it that they want to support other new members. And we are a small community because we're not aggressively like going after people. We allow people who find our content interesting to come and find us and learn inside the community. But you do have to be a learner. One of the main things is you do have to come in and want to learn these strategies. You want to spend some time learning strategies. But I tell people, you are not going to get a 10% raise at your job and do nothing. Even at an employer's office, they would expect you to put time into learning before they're going to give you any kind of return on on your income, on your salary. And so, if you want to be able to generate those higher returns on your overall stock portfolio or just inside your trading accounts, then you do want to be able to learn and to be able to diversify, because you don't want to be the kind of person where you're sitting through this and all you're seeing is your account bleeding and you're trying to decide, when do I need to cut the losses because I didn't cut it fast enough and now I'm just watching the account bleed to death. And or you're like sitting and hoping that at some point eventually 𝐸&Q is going to get back to 60 or 70 or 80, whatever your dollar cost average was for your shares. But like genuinely, if you've been doing these short straddles with us, you wouldn't have been like you wouldn't have needed to care, because the balance of the returns on your short straddles would have significantly helped mute the kind of negative returns on your share valuations. So again, if you thought any of this was interesting, please give us a like, subscribe, and then let us know in the comments what you found interesting, because it's easy to talk about this like all day long, but we know that that's not, people aren't necessarily interested in every aspect of options trading. So let us know what specifically kind of gets you going, or, gets you excited about options, so that we can really focus on those areas. But hope to see you guys in the Discord. All right, then I will say goodbye for now.